Per usual, everything on this channel is for educational purposes only and is not intended as financial advice. It's Teaching Tech Tuesday. Let's talk about dividends and yields and the yield trap or the dividend trap. And on the crypto side, this is specifically related to staking as well, because we of course have these mechanics in the crypto ecosystem. And most of what I'm going to say on the legacy side certainly applies, and then some, to the crypto side. So first things first, how do we even see the data on dividends or yields for treasuries or stocks? This is SGov. This is the short-term treasury bond ETF. On TradingView in the bottom right, I just learned this today myself. On the bottom right, there's a button, ADJ, where you can adjust for the yield. And what you're seeing on the unadjusted yield is the price change intra-month, accounting for the yield. But if we adjust for including the yield on the short-term treasury ETF, you can see that that changes things quite a bit. So over the past 2 years, 3 years, you can adjust this. Over the past year, the yield by the end of the year is going to be about 5.25, less of fees. In general, on something on the short end, you shouldn't expect price volatility. Now it's a little bit confusing here, I know, because this chart looks wonky, but when it comes to dividends and yields and understanding risks, there are risks for everything you own. And the important part is understanding what you own and understanding what those risks are. One of the bigger risks for owning yielding instruments is just opportunity cost. A lot of people aren't taking enough risk. That isn't necessarily a now conversation, that's a forever conversation. Depending on your age, if you are in your 20s, you've got years and years and years to keep swinging at the ball, and you can afford to take those risks. You really shouldn't be sitting in bonds if you're 20. But again, that comes down to your risk appetite, risk profile. If you are 85 and older, nearing the end of your life, do you want to throw your money in WIF? Probably not. Super high volatility, right? So we can analyze this stuff across the board. One of the better examples is TLT, the long bond ETF, versus Bitcoin. Okay, Bitcoin is like gold, a rock that sits there. It has no yield, no dividends, nothing, no staking, right? But TLT, total value, including price, including the yield, has lost significant value against BTC. So again, know what you own, know what you're buying, understand your risk profile, understand volatility. That's what this is all about. The other part of this conversation is, okay, we don't always want maximum volatility all the time. We don't always want a portfolio of 10 meme coins. What about the other end of the spectrum where we have some sort of blend, some sort of cozy, comfortable, reliable return that's a mix of volatility, a mix of dividends, a mix of yields? That can also be obtained usually with the 60/40 portfolio. And we can look at everything together. We can measure this stuff. This is the S&P in the white. This is the 40, the ag part in the pink down here. And you can see the S&P isn't tech, but it is relatively volatile compared to what the classic portfolio is for someone of X years of age. We can look at these target funds. We can see, okay, is your target retirement date X? That's going to adjust what the 60/40 components are. Maybe it's 80/20, maybe it's 90/10. If you're super young, you probably want the volatility just because most people are scared of downside volatility. They don't understand that they really need to be exposed to that upside volatility over time. Again, no, we're not talking, this isn't a now conversation. Markets are stretched, markets are expensive, whatever. But if we're talking about value versus growth, volatility versus no volatility, high risk versus low risk, as you age, generally, you want to take slightly less risk over time, maintaining that smooth return. So if we were to create a spectrum of things that we cared about and where to get that exposure, in general, low risk, no risk is perceived as something with high yield and no value, which currently in this current risk or interest rate environment would be short-term US Treasuries, money market accounts, government bonds in general. And then we can go across the spectrum. This is all relative. Of course, real estate might not be medium yield, low volatility. Right now, it might be no yield, extremely high volatility, right? This stuff is all kind of, again, back to know what you own. Corporate bonds a little more volatile usually, and then value equities generally lower yielding. But again, this changes over time, right? If rates come down on the low risk side of the spectrum, money's going to be looking for a home somewhere else. Money's going to be looking for a yield somewhere else. Currently, if you're in the low end of the spectrum here, your risks are reinvestment risk because you can't lock in that yield at 5.25 for an extended period of time. We likely have another couple of weeks before rates come down here, at least slightly, not by much, but slightly. So then that sweetens the pot for anything that's close to a competitor of the low risk side of the equation. That sweetens the pot for things down the risk curve, okay? Now us in crypto land, for the most part, we don't really care about yield. There's staking, it exists, I'll talk about staking, but generally that's not why most people are in crypto. Most people are in crypto for volatility of price and don't really care about the yield component at all. But where you can get trapped in this idea of yield, dividend, safety is this exact graph, TLT versus BTC. Now this is extreme. We can of course adjust this and say, what about SGov versus BTC? It's a little different, but the idea is very similar. You don't necessarily want extreme exposure to any one side of that equation in any one given time. A lot of people don't want to bother timing the market or thinking about timing the market. They're busy doing something else. So that's why usually 60-40 or 80-20 is some sort of preference for most people. But if you do have somewhat of an ability to trade, you can say, okay, high risk has done really well. That includes Nvidia, that includes Bitcoin for most of this year. Where can you take profit into? Where can you sit in until the volatility risk for the higher end of the spectrum comes down, where the valuations come down, or whatever fundamental metric you care about? Maybe the risk appetite in general of the portfolio is down, and so you can always hide out in these yielding instruments. And of course, it depends on time horizon. How long do you want to sit in this stuff? If the yield for the year is 3% and you sit in it for a week, it isn't very helpful. You're not really getting exposed to the yield component side of the equation. Now, most of us are aware, acutely aware, being in Bitcoin and crypto, of what's been going on with US bonds, especially on the long end, government bonds. The 40 side of the 60-40 portfolio continues to be in a heavy drawdown. And again, the general idea is we're not sitting on any one extreme side of the spectrum. We have some exposure to everything. This is the importance of diversification. Concentrate if you want to make money, diversify if you want to keep it. That's what they say. So you don't sit in US Treasuries for the price volatility. You sit in US Treasuries for the yield, obviously. We don't sit in Bitcoin for the yield because there is none. And arguably, you shouldn't sit in alts for staking yield either. That is, for the most part, irrelevant, especially thanks to unlocks, issuance, general inflation of these assets. For the most part, the yield is just a bonus. It's just part of the ecosystem of staking. I don't see most people saying, oh man, look at this yield on Cosmos. I can't wait to sit in this for a year, because they know the price volatility is extremely high. And that's really what we saw in March 2023 with SVB. SVB, the bank, of course, loaded up on high duration bonds. Those high duration bonds, aka TLT, went down in value, and they had to realize those losses. And this is the current losses for the US banking system in aggregate here from the FDIC. And this chart is, of course, floating around. So nothing is ever risk-free. There's always some sort of risk associated with anything. And that includes inflation. There is risks for the yield hounds and the dividend people on inflation, because if you're not beating inflation in aggregate over multiple years as a saver, as somebody who seeks low volatility, you're actually getting punished severely. And you'd of course have to compare this to all sorts of yielding instruments, all sorts of extreme risk instruments like crypto, Bitcoin, Ethereum, whatever. But it should be pretty obvious that something especially like the long bond, TLT, has gotten shellacked relative to inflation. Things like the S&P, NASDAQ, BTC have not. So I think if you're not used to taking the risk, if you're not used to exposing yourself to volatility in your portfolio, depending on your AUM, some people sort of trap themselves seeking extreme yield. You aren't beating inflation at all, and you're not really doing much of anything. You're not even treading water. If anything, you're drowning. So you do need some exposure to the risk side of the equation. Now we can look at ETFs that offer dividend yield, but like I said, there are There are so many options in fixed income. Definitely not my wheelhouse, but there are, of course, US options. There are non-US options. There are emerging market options, Asia, Europe, corporate bonds, globally, all sorts of stuff. Tons and tons and tons of options on the yield side of the spectrum. The easiest stuff to access is going to be anything in an ETF wrapper, because that's going to be ready to go in your brokerage. And there are, of course, tons of these, but you definitely have to know what you own. And you definitely have to know and understand total return versus price return, despite what these dividends look like. And depending on your portfolio and the blend of what you're seeking, some of this stuff can be attractive for certain parts of your portfolio. Sure. Covered call strategies, for instance, options income strategies, getting more and more popular. But I do think that those require an active hand a little bit into understanding what you're doing. Now, if you want sort of the low risk yield plays, those obviously exist as well. And we can look at how those have performed. That's just a list as of this month. We can go on TradingView, take a look. Some of these have done well, some of these have not done well. And it really depends on what you as an investor want, but I wouldn't get in this trap of only seeking yield, of only seeking dividends. Risk markets love to climb a wall of worry, and that's generally going to keep a lot of people who are overly cautious out of the markets, out of risk, and then they get eaten alive by aggregate inflation, right? Especially recently, since 2020, and we can back this up. Since March 2020, some of these have done much better than aggregate inflation, depending on how you want to measure it. If we go January 2020, something like that. Some of these have done well, some of these haven't. The ones that have done well probably have a lower yield, more risk exposure. So it's a sliding scale, depending on what you want. And unfortunately for most people, again, I think in times of fear, they seek out this yield stuff, which is fine. Look, it works out at the end of the day. But in times of fear, they should really be seeking out the risk side of the market. And they shouldn't be looking at these yielding products. If you just were to sit in the S&P, you're beating everything. You're beating everything. So what's the point, right? That's always the argument. If you're taking any risk at all and you're not beating the standard for the world, which is the S&P, why bother? Why bother? Before we go any further, let me mention today's video sponsor, Kraken Pro. Kraken Pro is a complete overhaul of the Kraken trading experience with a one-stop shop for advanced and professional traders. Kraken Pro enables efficient trading execution across multiple markets with a UI that allows for unique optimization tailored to your trading style. You can check out Kraken Pro with a link in the description of this video. Not investment advice. Crypto trading involves risk of loss. Cryptocurrency services are provided to U.S. and U.S. territory customers by Payward Ventures Inc., PBI, DBA, Kraken. In the crypto side of the equation, depending on your jurisdiction, you do have the ability to stake or obtain yield or earn through Kraken. Markets today sold off on US Open, and we've just been sort of sitting on these lows waiting to see what happens on the rest of the week's labor data. But Sol and ETH, of course, have yield. Doge does not. BTC does not. Most layer ones do. Most of the older layer ones do not. In the early days, to me, staking was always a way to force people to buy and hold, thinking of things like Dash or very, very old coins, that your total return on these coins relative to BTC isn't even close, right? It's not even close over the past 5 years. And then when we're talking about the total return of Sol versus ETH, the yield component, the staking component of Sol and ETH, largely irrelevant. We'll take a look at that relative to the price. So it's really just sprinkles on the icing on the cake. It's not even really a consideration for most people because price is so volatile. We can compare all of these staking, yielding type things across the board. If we go price change over the past year on stakingrewards.com, it also shows the reward rate, and you can compare all of these, right? So 7% over the past year versus 500% return, 570% return on Solana, right? So to me, the staking component, the reward, doesn't really matter at all, and really shouldn't matter at all, because most of the time these rewards are extremely low, whereas the price returns are extremely high. Aptos, sort of 50-50 there. Some of these are upside down. The reward rate on Polkadot is 11. Price return over the past year is negative. And you get the point. You know, do you want stable price with a high yield? Or do you want volatile price with potentially significant upside with a low yield? Right? Like, I think everybody would always take the volatility component, but unfortunately, a lot of people cannot stomach volatility. They just can't. They're allergic to it. It makes them sick to their stomach. They check prices too often. And so they seek out a smooth return over time. But again, inflation is always chipping away at your yields and at your returns. And so you definitely need to be mindful of that. There are, of course, other types of yielding instruments which have additional risks. When we're talking about restaking, there's peg risk, there's smart contract risk, oracle risk, all sorts of fun stuff. So I would definitely be careful on that side of the spectrum. And of course, we all know Celsius got in trouble for restaking and then jumping into DeFi, and then you're just taking risks on top of risks, or you're throwing it into Aave, and then there's volatility, and it's just more risk. And again, what do you really want? What are you really seeking here? Are you just seeking a min-max on your return with infinite risk? Because eventually you're going to blow up. There's going to be something, there's going to be some event, and you're going to blow up, right? So you can either size that down or reduce that risk a little bit and just say, you know what, liquid staking, probably not for me. Maybe I'll stick to just DeFi. Maybe I'll stick to just vanilla staking, but I don't want to put all of my portfolio, a massive percentage of my portfolio, into these super risky instruments, because typically price return alone is good enough in general. Now, if we compare total return of ETH in the purple to non-staked ETH in the red, not much of a difference. Now, this is only over a year, and yes, 5% is 5%, whatever it is, but it's not going to move the needle. What's going to move the needle here is price, and it's down over 50% against BTC. I threw in another one just for fun. Gold miners, there's a lot of people on the gold miners train lately. GDXJ is the ticker. But again, people trading GDXJ are not there because of the yield. They're there because of the price return and the volatility and the bullishness generally on gold. So thankfully, in crypto, at least I haven't seen too many people say, oh man, look at this staking yield. It's so juicy, right? Because then you'd be discounting, or you wouldn't be understanding the price volatility, because that's the most important part here. Lastly, I'll just mention another product not available in the US, but this is sort of the dream on the crypto side of things, is to have some sort of basket of stakeable tokens that provide a yield similar to this list. You know, this is a list of high dividend ETFs. Crypto's still super young. Staking, in my mind, still unproven as far as lasting over time. I like to say which proof of stake token has been successful over time. I think it's too early to say. It's way too early to say. A lot of these are flash in the pan. A lot of these have come and gone over time. A lot of these just wither away to nothing. But it's hard to say any of the proof of stake networks have necessarily been extremely successful or have had an extended track record over time. ETH doesn't count. That is freshly a proof of stake network. So this is the dream for most people. Is like, okay, I don't want to pick one. I want a basket that has a yield, that has a blend of a bunch of stuff, and be done with it. Interestingly enough, they don't have ETH in here. But you could always, of course, do this yourself on the crypto side. But again, that's not why people trade crypto. People don't trade crypto for the yield. So you're probably better off ignoring the yield completely, obtaining it if you can, if you plan on holding for an extended period of time, and then seeking yield, seeking dividends elsewhere in the TradFi ecosystem. That's all I have for this one. Like, dislike, comment, share, subscribe, and happy trading.